Hello guys, welcome to another video. Today we are going to talk about depreciation of property, plant and equipment. Actually first we need to know what is the depreciation. Actually depreciation is a process of systematically and rationally allocating the depreciable base of tangible asset over its expected useful life. So we have a few keywords here. First of all, what does mean by systematically and rationally? Actually, whatever the depreciation method you will use, the chosen depreciation method should reflect the pattern in which economic benefit or the services from the asset is expected to be received. For example, if you have purchased the asset and you might maybe you are thinking you are going to use this asset equally every year, so then you should use the straight line method, because straight line method of depreciation will give you equal depreciation. Okay, but if you feel this asset is new and you will use it more in the earlier years and you will use it less in the later years as this asset will get older, so then you should use declining method, because as per declining method you will get higher depreciation in the earlier years and lower depreciation in the later years. So this is what is called systematically and rationally. Now the second word here we have here depreciable base. Depreciable base is always equal to cost of the asset. From the cost you will subtract residual value, which is also called salvage value, and then you will subtract also recognized impairment losses. Okay, so this is what is called depreciable base. So this base you are gonna to split or allocate over the asset useful life. Now the point is, what is the asset useful life? Here we have a few definition. So asset useful life is always is the estimated period over which the services or the economic benefit are expected to be obtained from the use of the asset. Maybe if you have purchased a car and you are expecting that you will use this car for 5 years and you will get the benefits, so it means useful life of this car is 5 years for you. So what is the salvage value? Salvage value is also called residual value. Actually it is the amount which that entity expects to obtain from the disposal of the asset at the end of the asset useful life. Like if you will sell this asset at the end of useful life, what value you will get, that is called salvage value. Okay, so please remember, land we will never depreciate because it has always indefinite useful life. So here we go, which depreciation method we can use, okay, and what entries you will pass. So here first method we have straight line depreciation method. Okay, straight line, under the straight line depreciation method, it is the simplest depreciation method, and under this method what we are going to do, we are going to calculate the equal amount of depreciation in each period, okay, over the asset useful life. Okay, so this method is called straight line. Like when to use this method? If you are going to use the asset equally every year, so you can use the straight line depreciation method, because it will represent the pattern of benefit consumed from the use of asset. Okay, and here how you will calculate the periodic depreciation expense. So here the depreciation expense you will always calculate this way. We need a depreciable base. Depreciable base is always equal to cost minus residual value. Okay, cost minus residual value or salvage value, that is called depreciable base, and you are going to divide with the useful life. So this is how you will get the periodic depreciation expense. This is what I'm saying. This is the formula number one. You have a depreciation expense in each year. You have to take cost of asset minus residual value divided by useful life. So second formula you can also use. Sometimes depreciation might be given in the percentage, like 20%, 10% of the depreciation you are going to calculate. So then, so if you want to apply the straight line method, so your depreciation expense will be equal to cost of the asset multiplied by taxation percentage. Okay, and this formula usually we use for tax purpose, and the above formula mostly we use for financial accounting purpose. Now the point is, sometimes this taxation percentage is not given. If this is the scenario, how we can calculate the taxation percentage? So we need 100 over useful life. For example, If your asset life is 5 years, so you will take 100 divided by 5 years, automatically you will get 20% per year. Or in other way, sometimes it's written 1 over life, huh? So please remember here, if your asset life is 10 years, so you will take 100 divided by 10 years, so it means you will get 10% per year depreciation. Okay, but don't forget the second formula we use for tax purpose. So here we have a just implication of that formula, and we will see how to calculate the carrying value. For example, we have a company, JHA company, recently acquired a robot to be used in its fully automated factory for the purchase of 850,000. This is your purchase price. JHA spent another 150,000 installing and testing the robot. So this is installation and testing cost is also capitalized cost. Okay, the company's estimates that robot will have 5 years of useful life and can be sold at the end of the time for 100,000. This is your residual value. So first of all, we need to calculate the historical cost, and historical cost is equal to purchase price, which is 850,000, plus installation and testing cost, which is 150,000. So your historic cost is equal to 1 million. Okay, and from historic cost, if you will subtract, if you will minus the residual value, okay, salvage value, which is 100,000, so you will get depreciable base. At this depreciable base, you will use to calculate the depreciation under straight line method. Okay, so here we have now how to calculate the depreciation. So because asset is having a 5 years life, so first of all we will write number of years. So we have here year 1, 2, 3, 4, 5, because you will calculate the depreciation at the end of each year. So first we need to write it here, depreciable base. And depreciable base, as I told you, we have cost minus residual value. This is called your depreciable base. So here every year it is 900,000. I'm assuming residual value is not going to change. If there is a change in residual value or change in life, how to deal it, that we will cover in the last video. Once we finish all the taxation method. Okay, that thing we will discuss later. So here we go. So here we have a depreciable base, which is 900,000, and I'm assuming it's not gonna to change. So you will simply just divide it by the estimated useful life, which is 5 years every year, and it's also not gonna to change, we are assuming. So this equals depreciation expense. Okay, every year you will have 180,000. Okay, over the 5 years. Now the point is that what entry you will pass in each year to record the depreciation. So entry you will always pass debit depreciation expense. Okay, you will take it to the income statement, and credit you will credit the accumulated depreciation. Okay, you know, depreciation expense you will take it to the income statement, and accumulated depreciation is your contra asset account, which will reduce the carrying value of the asset in the balance sheet. Okay, now we have here accumulated depreciation. If you want to talk about for the accumulated depreciation in the first year, your accumulated depreciation is only 180,000. Okay, in the second year, if you are sitting at the second year, so your accumulated depreciation will be the depreciation till date, which is 180 plus 180, it will be equal to 360,000. If you want to calculate depreciation, accumulated depreciation for 3 year, you have to add 3 depreciation. Okay, so this will be equal to 540,000. So this is how accumulated depreciation will increase every year. Okay, and now if you want to calculate the carrying value, please focus here. The carrying value in first balance sheet, let's assume this is your balance sheet, and this is year one we are going to talk about. In year one, how you will record your asset in the balance sheet, you need a cost of asset, which was 1 million in our example, minus accumulated depreciation. In the first year we have accumulated depreciation only 180,000. If you will subtract, so it means our carrying value will be equal to 820,000. This will happen in year one. So in year two, what you need to do, guys, in year two, same, you will write the cost, which is 1 million. From the cost you will subtract accumulated depreciation. In 2 years, in second year, our accumulated depreciation is 360,000. If you will subtract, so this is how you will get the carrying value of 640,000. Okay, this is how you will record your asset in the balance sheet over year one to through 5 years. Okay, so and this expense, depreciation expense, every year you will take it to the income statement. Okay, guys. So this is how you will deal with the straight line method. So here we have, now we are going to talk about the depreciation, okay, on the fractional basis. Sometime maybe if you have acquired the asset in the mid of year, because in the first year just you are going to use asset for 5 months or 6 months, so ideally we should calculate the depreciation only for 5 months or 6 months, or for the period which you have used. Okay, so here we go. For example, let's have a look how you will calculate the depreciation and how you will apply the time fraction. If for example, if we have purchased the asset in October 1 and our end is 31st December, it means from October 1 till 31st December we have used 3 months. Okay, so what annual taxation in the first year, let's assume it is 140,000. This is the annual taxation. For example, I'm taking from above because our cost was 1 million in our example, historic cost, minus residual value was 100,000. This is residual value divided by life is 5 years. So this is how you got taxation per year, 180,000. Now, but assume the first you have purchased the asset on October 1. So now what you are going to do, because you have used only assets for 3 months. So that's why you are going to do calculate the depreciation for 3 months. But this is your annual depreciation. So what I'm going to do, I'm going to take annual depreciation multiply by 3 over 12. 3 is the months which you have used, 12 is the total number of months in a year. So this is how you will get the depreciation for 3 months. Now with this depreciation in the first year, so what entry you can pass, debit taxation expense and credit accumulated depreciation. Now we have a other method which is called declining balance method. This is the second method because I will cover these two methods and the comparison how the question will be tested in exam. So here we have a declining balance method, which is also called time-based method. Actually, this method is going to give us a higher depreciation in earlier years and lower depreciation in the later years. Okay, and this depreciation method we should use when you expect higher benefit from the asset in earlier years and lower benefits in the later years. Okay, then this method will match the taxation expense with the benefit consumed. Okay, so here what you will do, the taxation expense in each year, how you will calculate, you need a carrying value of asset. This is the only method where we will use the carrying value of asset to depreciate. Okay, not the depreciable base. And carrying value of asset, how you will calculate, you need a cost of asset minus accumulated depreciation. This will give you carrying value multiplied by depreciation percentage. Okay, so this is how you will get the depreciation expense in each year. Okay, because over the years what will happen, actually your accumulated depreciation will go up, so which will reduce your carrying value of the asset. If you will multiply the carrying value of asset with the depreciation, so your depreciation expense will also reduce over the years. Okay, please note, salvage value is ignored in determining the carrying amount, but the asset is not depreciated below the salvage value. This is a really important point. Okay, when you calculate the depreciation, we can ignore the salvage value, but your depreciation, I'm sorry, your asset carrying value should not be below the salvage value. How? I will apply this concept through the help of example. Don't you worry. So here we have a accelerated. There is a one more method which is called accelerated, a double declining method. Actually, it is the declining method, but here what we are going to do, just we want to depreciate our asset quickly. So that is why what we are going to do, we are going to double the straight line rate. Okay, for example, if your asset life is 5 years, so we will take 100 divided by 5 years. So our taxation is, for example, 20% per annum. But if you want to use double declining, just you will multiply, you will double this rate. So 20 times 2, it will be a 40%. It means you will use a 40% rate of depreciation to depreciate the asset. Okay, this is what is called double declining method. So here we go, because in exam sometimes they will ask you to apply double declining. So you have to calculate the depreciation percentage as per straight line, and then you have to just double it. Okay, so here how you will calculate the depreciation expense in each year. What you need, again, you need a carrying value of asset which is equal to cost minus cumulative depreciation multiply by depreciation percentage. Here what your depreciation percentage just is gonna to be double, otherwise formula is the same. Or in other words, we can apply this formula also for the double declining. You have a 2 multiplied by 1 over n. 1 means it's like 100, and stand for estimated life. So if you will take 1, for example, life is 5 years, point 0.5. I mean to say 1, you can assume it's like 100 divided by n. For example, if life is 5 years, so you will get 20%. This 20%, you will actually, this is the 20%, multiply by 2, it will give you a, it will increase, it will double your depreciation rate. Okay, then you need to multiply with the carrying value of asset, and carrying value of asset is equal to cost minus accumulated depreciation. It's also the same formula which we wrote it here, just in different way. Okay, so here we go. Now let's have a look with the help of example, and let's see what is the, how to depreciate it. So here we go. We have same data. We have a Jayhawk company recently acquired the report. The cost is 850,000. Installation and testing cost is 150,000. So this is your total storage cost. Total storage cost is $100,000. Salvage value is 10. I'm say 100,000. Okay, you once you will take a storage cost which is 1 million minus salvage value which is $100,000. Okay, so you will get the depreciable base which is equal to 900,000. But when you calculate the depreciation under declining method, this residual value you don't need to subtract from here. Okay, so how you will do it, let's have a look. So now you want to calculate the depreciation in each year. This is the format you can apply, and we are going to apply double declining rate, please. Okay, because asset life is 5 years, 100 divided by 5, our depreciation percentage was 20% per annum, and as per requirement we are going to apply double declining balance method, which you will just multiply with the 2, you will get depreciation rate is 40%. Please look at the calculation very carefully, because things are going to change now. Here we go. First of all, you will write year. We have year 1, 2, 3, 4, 5, because at the end of each year you will calculate the taxation. So you will start with the carrying amount first of the year. Okay, I like at the start of the year. So what we have here, carrying value is always equal to cost minus accumulated depreciation. In the first year your cost is 1 million, accumulated depreciation is 0. The reason is that we are going to calculate the first depreciation, so that is why your cost will be equal to the carrying value in the first year. Just you will multiply with the double declining rate which is 40%. If you will multiply, you will get depreciation expense of 400,000. With this expense, you will pass the entry debit depreciation expense, credit accumulated depreciation. Now this will be equal to your accumulated depreciation. Same depreciation expense will be equal to accumulated depreciation. And now you want to calculate the carrying value. Carrying value is always equal to cost minus accumulated depreciation. The first year cost is 1 million. Accumulated depreciation is 400,000 in the first year. This is how you got a carrying value, which is 600,000. Okay. This carrying value, what you are going to do, it is going to become the carrying value at the start of next period, multiply by again 40, you will get this much depreciation, 240,000. Now just add these two depreciation. This is, if you will add these two, only first two. Okay, this is going to be your accumulated depreciation 640,000. Okay, now again cost minus accumulated depreciation. Cost was 1 million and accumulated depreciation is 640,000 in second year now. So your carrying value will be 360,000. Okay, this 360,000 which is at the end of second year will be the beginning for third year. Okay, again what you are going to do, apply 40%, you will get 144,000 as a depreciation expense. And now your accumulated depreciation will include these three value. Okay, these three value. Okay, so I meant say these three, sorry, these three value, this will be equal to cumulative depreciation, which will be 784,000. Now again in the year 3 your cost of asset was 1 million and your cumulative depreciation is 784,000. So you will get carrying value is 216,000. Look at the magic, what it's going to happen in the last year, please. So this 216,000 will be beginning for next period again times 40%, it will be 86,400. And now your accumulated depreciation will be these four depreciation will be your accumulated, which is 870,900. Okay, now you will look at here, your cost is 1 million in at the end of year 4, your accumulated depreciation is 87400. So your carrying value will be 129,600. Okay, so this carrying value will be the beginning for next. Here we have a magic now, I mean say point to understand now. Okay, so you have a beginning carrying value 129,600. Guys, if you will apply now 40%, so this will be equal to 51,840. Please check, huh? Or you can recalculate on your calculator. I guess it is 51,840. But you can look at here, depreciation is written only 29,600. But if you will apply 40% of 129,600, so it should be 51,000. Okay, the reason is that your total accumulated depreciation should not be more than, I mean to say, should not be more than depreciable base, or your carrying value of asset should not be below the residual value. This is really important point. Okay, let me just prove what it's gonna to happen here. Actually, guys, this is what we have already learned here. Just let me put it here, value. If this depreciation, if here instead of 29,600, I will put the complete depreciation, which is 51,840, which is 40% of 129,600 times 40%, it is 51,840. So if you will make the summation of all depreciation now, okay, so this will be more than 900,000. It means your depreciation, accumulated depreciation is going to exceed the depreciable base, which should not be like that. Okay, so now what it means here, your total accumulated depreciation should be equal to $900,000 total accumulated. Okay, so let me just show you this working through the help of example, please. Here, guys, in year one, you have here depreciation expense of 400. This is the actual expense. 240, 144, 86, 400, 51, 840. If you will calculate 40%, this is the value. So you will look at here, your total accumulated depreciation is going to exceed the depreciable base. Depreciable base is $900,000 only, okay? But your total accumulated depreciation is going to be $922,240. So it means your total accumulated depreciation should be equal to the depreciable base, and depreciable base is 900,000. What happened in year one, you have calculated this depreciation. Actually, in year two this, year three this, four this, you can just refer to the previous calculation. And year five, I will not write 51,840, I will just write the balance. Because if I will write 51, my depreciation exceeds the depreciable base, so I will just write the balance, which is 29,600. Okay, so that's why my accumulated depreciation will be equal to depreciable base. Okay, or in other words, your total accumulated depreciation should be 900,000, which is depreciable base. Okay, what you can do from here, you can subtract first 4 years accumulated depreciation. First 4 years, these are four values, first 4 years. Okay, you will subtract this value automatically. Once you will subtract this value, total of that, so automatically the last year, fifth year balance should be 29,600. This way you can also calculate. Okay, and the second one, now look at here, what is the main thing. In the last year, as I told you, your asset carrying value should not be lower or below the salvage value. In the last year, what will happen, guys? Now let me just show you from the above calculation. So in the last year, so your cost of asset was 1 million minus accumulated taxation, which will be exactly equal to depreciable base 900,000. So your carrying value will be equal to the residual value. This is what they're telling you. Your carrying value should not be below the residual value. This is the point. Okay, like here what we did, we just calculated the balance in the last year as a depreciation. The balance is how much? 29,600. I hope it is clear, guys. Now guys, we have here comparison. Sometime, most of the time, they ask the questions about uh, comparison of straight line method with the declining method. So here, first of all, guys, here we have a column for depreciation expense. This is the column for profit. This is the column for retained earning, accumulated depreciation, and carrying value. Okay, so here we go. In earlier years mean to say at the starting years of the asset life. Here we have a straight line method. Straight line method will give you lower depreciation because in our calculation straight line gave produced $180,000, and on the other hand declining method produced 400,000. I guess this was the depreciation, just you can refer. So straight line method will give you lower depreciation. If depreciation is lower, it means profit will be higher. If profits are higher, of course your retained earning in the current period will also be higher. Okay, and if your depreciation is lower, so your accumulated depreciation will also be lower, and your carrying value will be higher. Because if your accumulated depreciation is lower in balance sheet, what you do, you record the cost minus accumulated depreciation. Okay, this is equal to carrying value. If your accumulated depreciation is lower, automatically your carrying value will be more. Okay, so same here in the earlier years, declining method gives you higher depreciation. It means lower profit because expense is more, and retained earning will also be lower because your profits are lower. Accumulated taxation will be higher. Why? Because your taxation expense is higher. That's why accumulated taxation will be higher and carrying value will be lower. But in the later years, what will happen? It will opposite. It will work opposite. So straight line method will produce higher taxation in later years because there is a constant taxation which will not change. But under the declining method, taxation will be lower in the later years. Okay, so that is why high taxation means a lower profit. Lower profit means a lower retained earning. High taxation means a higher accumulated taxation, and high taxation expense mean to say high accumulated taxation mean to say lower carrying value. Okay, so on the other hand, we have a declining method. Declining method will give you lower taxation in the later years. It means a higher net income. If net income is higher, your retained earning will also be more. If your taxation is lower, of course your accumulated taxation is also going to be lower and carrying value is going to be high. I hope guys it is clear. This is how you will deal with the straight line method and declining method. See you in the next video. Thank you so much. Bye bye.